Welcome. We have two guests today, Michael Abrams and Josh White. So Michael has been with us several times. Michael and I are collaborating on a course to help folks understand how to negotiate and create management agreements and other creative co-working partnerships. Josh White is a guest today. I met Josh through the GWA. Josh, I think we maybe coerced you to speak, and then we wrangled you onto the advisory board. So, but I'm looking forward to our conversation today. Josh is the managing director at MRP Realty, and he's going to talk about their Heyday Properties services platform. Michael has teed up some questions to ask Josh about their experience and some forward-looking sort of plans around flexible office. So we're going to dive right in. Michael, I'm going to hand the microphone over to you. I'll let you start. And both of you give a little more context for an intro if you'd like as you begin.
Sure. Thanks, Jamie. And thank you, Josh, for taking the time. So MRP Realty has been, I guess, in my view, as an outsider, they've been slightly ahead of the curve with innovation, creativity from office buildings to industrial. They're mainly focused on the East Coast, I believe. Is that correct, Josh?
Yeah, that's correct. I if you look at across our portfolio, including industrial,
Yep.
we span from New England down with a recent focus in the Southeast and the Sun Belt. And so we're in Nashville and some large developments, and really looking at the Charlotte and Raleigh markets that we like as well.
Right. Well, from an outsider, they are very well respected, and most of their projects, I'd say actually maybe all of their projects, there's this great energy and synergy that they create, and they do quite well. So with that, and with this emergence of flex and hospitality in the office market, many years ago was this vision to create its own brand called Make Offices. So, I always try to learn, and we try to get folks like yourself to teach us, what was the vision? What was the early on objectives? What's interesting is when I started the business in Flex, I came out of a real estate company very similar, but we had a different approach. And I think because of MRP's size and scale, I think, we can learn from that expertise about, what you've learned and the trial and error process that goes along with it. So I'd love to know just, the origins and how it was created, why it was created, who was your target user, and that kind of stuff.
Yeah, so the journey with MRP and flexible office, the initial exposure was very akin to what all of our members probably start out in. We were actually renovating. We were renovating our offices, and we all moved into Make Offices. And instantly, what appeals to so many in co-working, especially sort of the early days of startup culture, single shingle businesses, entrepreneurs, just the excitement and the energy that sort of happened in the hallways. And so that was our first introduction into it, and it led to a investment in Make Offices. And so that's how we kind of came to eventually, through additional rounds of investment, have operating control of Make Offices. I served as a role there, and a lot of that capital that we put up for the business went towards expansion and took Make Offices to 15 locations. And then I think, from a trial and error standpoint that you mentioned, we've had a change in thinking. We're still really long co-working, flexible office. We feel that segment of the market, as is predicted, will continue to grow. Where it fits in the asset, we are always looking to put flexible office in the asset, be it traditional co-working or spec suite programs that are serviced and amenitized and pre-furnished. So now we've kind of fallen back to a position, and it's coincided with the pandemic, that we just want to operate within assets we manage and or own, that we're a capital partner on, that we're repositioning. So that means a couple of the old make offices have come under our new portfolio, but we transitioned a lot of the others, either reassigned lease and or transitioned them to other operators where we had been in arrangements where we were tenants.
Right, right. So when Make Offices is in an MRP Realty building, even though they are separate, what does that structure look like? Is that a lease? Is it a hybrid? Is it a partnership? How do the two entities do business together?
Yes, they're partnerships, but the details of each arrangement are different and to comply with REITs and things like that. But essentially they are management agreements, but they can have they can have the look of a shopping mall or a parking type of lease for REIT compliance. But we are working to in conjunction with asset ownership and the landlords to fund the operating expense, and then there's typically some sort of share in revenues beyond that.
Right.
That's described at a very high level. Yeah.
Right. So when you guys were expanding outside of your portfolio, that's a huge jump for any group. As were your deals outside of your portfolio in a similar light, or were you having to sign actual traditional leases?
Yes, we during that expansion period, we were signing leases. So those locations that transitioned to new operators kind of at the beginning of 2020 had been taken up as leases by Make Offices.
Right. And so, because that rent arbitrage game is so volatile, even in a good climate, much less having to deal with a pandemic. There's so much learning experience by having to go through that turmoil and stress. What would you highlight? What would you tell people to look out for?
Yeah, so I think and this was predicted, right? I think there are a lot of people who were waiting for that first downturn to pressure test the co-working model under a lease on this. And so we saw that. We got that pretty quickly. And I think that people asking those questions were right. And that you cannot have your single market leading feature and benefit being flexibility. Your primary selling point then becomes your primary weakness very, very quickly, and that's obviously what happened. And so that's why you've seen a pendulum swing to management agreements, better alignment both on upside and downside that I think was happening. I don't think that what's interesting is I don't think that the pandemic and what has happened to revenues due to sort of a flight from co-working for a period of time has impacted the reputation of it as an office product segment. And in fact, I think it's right now we're going through the opposite of that. And that's because, yes, it's the first segment of the office market to feel the flight because of the flexibility that is its selling point. But it's also becoming the first to feel the return and
rebound. Yep.
And we're in the midst of that. I think in the local markets we're in, May, June, and the first 2 weeks of July were just, we were on fire. I think sentiment due to variants and returns of restrictions has dampened that positivity and return to office. Some things have been put on hold, things like that. But flexible office was absolutely where everyone was returning to.
Yep.
And we're seeing that. So, yeah.
Hey, I just wanted to jump in really quickly before we continue with our discussion. If you're working on opening a co-working space, I want to invite you to join me for my free masterclass, 3 behind-the-scenes secrets to opening a co-working space. If you're working on opening a co-working space, I want to share the 3 decisions that I've seen successful operators make when they're creating their co-working business. The masterclass is totally free. It's about an hour. It includes some Q&A. If you'd like to join me, you can register at everythingcoworking.com/masterclass. If you already have a co-working space, I want to make sure you know about Community Manager University. Community Manager University is a training and development platform for community managers, and it can be for owner operators. It has content, training, resources, templates from day one to general manager. The platform includes mini courses that cover the major buckets of the community manager role, from community management, operations, sales and marketing, finance, and leadership. The content is laid out in a graduated learning path, so the community manager can identify what content is most relevant to them depending on their experience and kind of jump in from there. We provide a live brand new training every single month for the community manager group. We also host a live Q&A call every single month so that the community managers can work through any challenges that they're having or opportunities, get ideas from other community managers, build their own peer network. We also have a private Slack group for the group. So if you're interested in learning more, you can go to everythingcoworking.com/community manager. Michael, can I speak in with a follow-up question?
Sure.
Josh, you mentioned in our pre-chat, you kind of talking about circular value creation within a building and how you mentioned sort of asset build out, market fit. So in your new product, and I'd love for you to describe what that looks like, and talking about circular value creation within a building, is the flex always there to turn a profit, or is there another sort of ROI for that business?
Yeah, so circular value creation, sort of reciprocal value creation, that's what we talk about when we have this perfect sort of office product fit to the asset and the submarket. So it's really feeding off the demand, and the office environments in the co-working and spec suite floors fit what tenants are coming to that building for. So you don't have kind of a company culture or company lifespan disconnect where all of your gig workers and startups are going to the co-working floor, but then you've got your law firms and your consultants going to the rest of the building. If you want integration, if you want value creation, you need all those things to fit. And what we see when we can get it firing on all cylinders and get that to work is, and just for simple math, in 100,000 square foot asset, we will see in a year graduating from co-working either into spec suites or traditional office between 7,000 and 10,000 square feet. So we're kind of co-working's a launching pad on that circle, feeding the other types of longer term office product, and then coming back the other way for various reasons. They're renovating, they're expanding, they're in between office size, they're waiting for space to come back on the market within the building. We see about 15 to 20% of the co-working occupancy being taken up by the other tenants in the building. And so in the second half of that question, yes, it's for a profit. We do see it as an amenity, but it still does need to stand on its own and turn a profit. And like I think most out there, we are looking for it to deliver at a minimum market rent, at a stabilized occupancy.
Right. And with your portfolio, you do attract a lot of big national tenants. Do you find today because of everything we've seen with the acceleration of flex, are potential tenants asking for flex before they make a commitment to the building?
So yes, we are absolutely seeing that more and more requirements for flexible components in the building. And so I think as that comes, and I believe that Europe and especially the UK have been sort of the leading edge of that. We probably 2 years ago, we started to hear about that being baked in as a requirement to more often, searches for companies out on the market for office space. So they see that as a sort of a built-in valve to expand into and things like that. So it's certainly seen as an amenity. We're repositioning an asset right now where we're chasing a very, very large tenant user who has that requirement, and the building doesn't have flexible office right now, but it allows us to sort of collaborate on what that space is going to look like for them. And so they've got a requirement of having flexible office in the building. We say, hey, we're going to build this out contingent on going to lease with you all, and we will take your feedback in the design of that space.
Right, that's awesome. So, we've come full circle, from Make Offices to Heyday Properties. You guys are out there, you're very, very active. Like if you could look into that crystal ball, like where do you see this demand going in the future? Because, so many groups today, they're looking at the enterprise groups. And as we discussed before we got on this call, we talk about how, the backbone of America is on small companies. So how are we looking to satisfy everybody, or are we just going to focus on one subset?
Yeah, it's great. Thought-provoking question. I'll go to the kind of the first part, which is so crystal ball, kind of where we see things. I think we're in a period of increased demand, a bolus of demand for flexible products. I think that the driving force behind that is just uncertainty, and mostly employee-driven uncertainty, head counts, workstation counts, things like that. How, we've always thrown around the term future of work, but we're actually kind of staring at this period, like everything beyond this period is actually like kind of like a new dawn, right? For how we're working.
We're in the future.
Yes, we are. We're toes are in. So I think the demand is mostly being driven by the desire to buy time, kind of kick a can for a while without signing up and making too long of a commitment on space. Because you talk to these decision makers, and yes, they're surveying their employees about who wants to come to work, how often, these sorts of things, and that data is moving, right? Just as sentiment around the country, consumer sentiment, all these sentiments changing at the whisper of a new variant or the increase of a infection rate and positivity rate in certain periods. We feel that we're almost like canaries in the coal mine because of the flexibility that a lot of our membership has, at least within our co-working floors. So I think these decision makers, the last thing they want to do is sign up for 10 years and whiff on that, either too small or too big. And so a lot of new business won over the last 4 or 5 months, and we're seeing it play out on a monthly basis, are those that have wanted to equip themselves with the ability to expand and contract as their employees either grow in confidence and wanting to come back to an office environment, or all of a sudden the next month, again, I said mention of a new variant or something like that, decide they don't want to, so they can shed and or add seats monthly. And we're seeing that.
Right.
Thank goodness right now it's all in the positive. Our spec suite programs, which we'll do 12-month terms on, have absolutely been across our portfolio one of the most in demand sort of office types, the pre-furnished, pre-wired, serviced.
Right.
But again, I think that this is to buy time, to have better line of sight to what that next office was going to be. And I think if I had to guess, I think in the next 24 to 36 months, we'll start to see longer term commitments back into the 7 to 10-year term length. I'm not sure if it's going to be on a consolidated basis through kind of pre-pandemic square footage footprints, because I think workstations will be down, but I'm not sure overall space needs will be down, because you hear a lot talking about team rooms, collaboration rooms. Hey, if this team's only coming in once a week, well, they still, all 10 of them need to be there, and things like that. So I can't sort of predict that. I think that the environments in terms of workstations and open desk seating and all that's going to change.
Right.
And again, we do see that, because a lot of our members, where they would just take private office, are now taking a private office and a room for a team room and a room for a conference room, even though they can go into the shared conference room. So you're actually seeing a lot of, a lot of tenants taking down multiple offices, but repurposes them for separate uses.
Right. So here's something interesting. And we all observed this with the pandemic. Other than members fleeing, there was such a difference between urban core centers and suburban locations. And you're not, we're not reading a lot about this differentiation, but for those of us that are in the business, we've seen just huge ups and downs with suburban locations versus urban centers. What's your view on that?
I'm not sure I have a strong view, but I'll tell you what our observations were. And that was absolutely during the pandemic, so pre kind of vaccine availability, we felt that suburban locations, or sort of edge urban, maintain the best occupancy levels. And our belief around that was it's a mode of transportation. They're most often served by surface parking, and they're much less likely to be accessed via bus or metro, which there's a lot of apprehension about, right? So that's the belief that we thought around there. In terms of a return, though, we're seeing much better return and releasing in central business district locations. And again, that's more of like a socioeconomic / demographic belief. There is in that those edge / suburban, more single family homes, therefore more likely to have a home office, more kids, so they're waiting for kids to go back to school and things like that. Whereas central business district, more multifamily, more dense residential, less likely to have a home office, more likely to want to get back and collaborate and be amongst their peers and things like that from a social set standpoint. So those are the two things we've seen at play.
That's great.
Hey, I wanted to just interrupt. Josh, can you just kind of give us an overview of what the Heyday model is like? Because we started talking about make offices, and Heyday is a full building solution, which is still somewhat unique and flex. I'd love to hear, and very hospitality focused. I'd love to hear what that looks like.
Yeah, so absolutely. So MRP, kind of the reputation and hallmark, at least in the commercial, in our commercial division and office division, is repositioning, right? Working with capital partners to develop a new story and strategy to improve an asset, improve leasing velocity and rates and things like that. And property management, we feel, is a tool in repositioning, as is flexible office and amenities. It's not just the rooftop, the gym, and redoing the lobby. It's adding other things. It's adding a lot of times a differentiated property management, which is Heyday. And I think when we talk about hospitality or differentiation or experiential, I want to give the credit to the team that developed that, because it was sort of re-engineered. They spent time with the Ritz Group. They spent time with, the brands out there that you believe are hospitality. So this isn't just lip service or checking a box or dropping words like hospitality into a deck, right? You feel it, and it was engineered from the experience from dropping off your car, how you enter the parking garage. I mean, it was just absolutely, soup to nuts, re-engineered, and that's what Heyday is. And a lot of it's driven by technology, a lot of it's driven by design, and a lot of it's driven by the amenities that are in there. And so that's what Heyday is. And so co-working and flexible office type, office products are within Heyday. We operate them in traditional non-differentiated property management, but also in the Heyday managed asset. So that's one unique thing. The other unique thing is, although I think we're going to see more and more of this, is that operations of the flexible office. So when I talk about operations, I mean sales, marketing, touring, negotiations, servicing day to day. It's handled in an integrated fashion to property management. And so the economics of that model are very, very different than it's really a self-operated model. It really is. So you leverage economies of scale in things like your janitorial service, your security, things like that. And so it's a very, very ownership friendly model, as long as the group that's managing it has flex experience. And so we've just seen it as being way, way more profitable for ownership to a lot of the third party, operators out there. There's some great ones out there. But I think across the board, it can be very beneficial. It's something that owners should consider.
That's great. No, I mean, there's a clear path and vision in the future, teaming up flex with technology and design. I mean, you hit the nail on the head. I guess at the end of the day, while we talk about it a lot, the one thing that we all have learned is it takes a lot of capital. It takes a lot of time. It takes a lot of effort. So many landlords took this lackadaisical attitude toward flex, thinking that you just put up spec suites and it leases themselves. We've all learned through this experience, it's not as easy. Having watched MRP, we've also seen some other great landlords like Hines and Tishman Speyer and even Brookfield. Everyone's testing it out. I think, you guys obviously, you've learned a great deal. You've reorganized, you restructured. I think it's a compliment to you guys seeing value and reorganizing in a manner that you only come out stronger and better. I mean, it speaks volumes for itself. So now that you're staying within your portfolio, I know you make offices at one time was up to 15. How many buildings within your portfolio are you now offering flex?
Yes, so there are 11 flexible or locations with flexible assets in it, and that can be either our co-working, or it can be one of our spec suite programs. Town Hall is one of them. We're kind of known here, at least locally in the DC market, for Town Hall, which was kind of pioneering at the time. Was created 5 or 6 years ago by MRP, and really what it is, it's a natural kind of graduation or extension from co-working. What you do is it's private office suites. The office suites have small huddle rooms or conference rooms and management offices, and usually a kitchen like a spec suite would have, but it's all wrapped around a central core of amenities like you would find in co-working. So there's large conference rooms in there. There's large event space. There's a large, kitchen area for entertaining and things like that. Rooftops, balconies, all of that. And so that product has done great. This location I'm in right now, go back to that circular location. We've delivered various things as part of this repositioning in 2010. The food hall has opened and is slowly opening. The flexible office, the co-working was delivered. The spec suites haven't. We've got white box space behind me that some spec suites are going to go into. 4 of them are going to go up here. There's going to be a lot more down on the 4th and 5th floor. I'm up on the 10th floor right now, which is the top floor. There is a wait list from the co-working floor for these 4 suites.
Oh, that's great.
7 deep right now. We haven't even had the plans approved. So that's another aspect of asset value creation and how the asset and ownership benefits from flexible office, but it also takes that product fit that we've talked about, because the environments match, right? The type of client and member that's going to go down that co-working floor can see themselves up in here or in the traditional office space here.
No, you just said the special words: organic growth increases margins and makes every stakeholder very, very happy around the boardroom.
Yeah, well, we've got a stretch goal that that we do 20% of our deals outside of co-working direct in an asset. So that either, what we would define as direct is graduating out of co-working or comes in through the digital marketing of co-working and ends in a suite. Right.
Which, you hit on something else right there that we didn't discuss, which is, how are you getting your leads? How are you getting your members versus the tenants, which is total diversion from the old way of thinking, because now we're all into this technology and the analytics. I guess you have the benefit of getting it from wherever you can. You're getting it from different sources.
Yeah.
I assume you're still employing the lead generation through Google Analytics.
Yeah. So all the traditional digital marketing tactics that we did as mega offices, we're doing now, and then some. So one thing in kind of surveying the market and going back and recapturing from a data-driven or analytically driven way the conversations we're having with members, we believe that there is an opportunity in the market to be more kind of consultatory to these leads. And so in the near future, we're going to be kind of rolling out a new brand that is to do that, because we've got a lot of people who come to us thinking they want co-working, but really wanting private space. Or we have people that come and tour space and be like, oh, this isn't what I was looking for. And we kind of word mapped a lot of those conversations recently. And it brought us to the realization that we can actually be a service on the intake of a lead that's looking for space or signs up for a tour. That pre-tour, which we've always done a really good job of that intake conversation, but taking it to the next level of, okay, do you have line of sight to where you're going to be 12 months from now? What's confidence level around term? How important is privacy? How important is amenities? All of those things. And that's just a small sample of the kind of questions and the conversations that we're having. And so that allows us to really place them in just a ready now spec suite that it doesn't have the amenities, because, elevator bank exposure is not that important or something like that. Right. Or, hey, you know what? We're a second, third generation family services company. We know exactly how much space we're going to need. Expansion adjacent to us or within the asset isn't that important. And we can kind of tease all that out. So that'll be coming, pretty soon. We're excited about that. And then each of our products will sort of sit under that umbrella consultatory service. And that way we can kind of place them in the right product type. And really the objective is the most efficient capital expenditure on real estate in any metric that they, that they track, whether it's, per workstation, per employee, per what. is what will drive. We want to arm them with the efficiency of those dollars spent and put them in the right space.
And Josh, well, those conversations would be had regardless of lead source, so broker, digital, like will they funnel into, and then who has that conversation? Is it a broker? Is it the leasing agent? Like who is that?
Yeah, so that's us a lot. Sometimes that's myself, and it's the kind of the commercial team that sits on Heyday and our flexible office. So sometimes it's actually our asset managers early on having those conversations. We're evangelizing a lot right now, spreading sort of the gospel of flexible office. That's another interesting thing we haven't touched on that we've seen in the pandemic. We've absolutely seen an increase in broker-led deals. I just mentioned before that our stretch goal is to see 20 to 25% direct non-brokered because we're graduating them up and or they're coming through our website, and we're realizing that traditional office and or spec suites are the right fit for them for various reasons. But we've seen a significant increase in broker deals as well, and I fall back on old make office data. It was maybe 10% were brokered. So the other 90% were either friends and family of existing members, or they were coming through digital marketing demand gen, right? But now we've seen that's up to 30-35% brokered. I think that's because requirements that were out in the market have now shrunk down to something that's either more co-working, and it goes back to what we were saying before. They need to wait it out, and they need to wait it out in a situation that is month to month or sort of short time, so they're not tied to it for a long time. But I also think there was probably financially driven as well. I think probably some broker commission dollars were driving up, and they got a lot more creative than they ever did and said, hey, well, you might not need the full 15,000 square feet, but what about this team that needs to be better? Can we get them a 10-person office? I think there was probably some of that going on as well that we've seen. And it's also, it's also because I've had these talks, they want to make sure that when it's time to move back into that 10, 15,000, that they haven't lost them as a client because they found them the interim solution. So
That's great.
Michael, last question.
No, I think we hit it on. Josh, this is so informative. This is great. I think just, where you've been, how you reorganized to where you are, it just speaks volumes of how you've realized throughout the entire process where your focus is, where your tenants, how you can satisfy your tenants' objectives. And you seem to be marrying the design aspects, the technology aspects, and probably more importantly than anything else is the hospitality aspects that you're introducing into the office environment. It not only speaks volumes to, as we say, the future of work, but I think you're also finding what it does to value of an asset, which at the end of the day, that's what you're trying to achieve. So, this is great because, you guys are DC based and, you've learned a great deal and you seem to be thriving on, what you've learned and where you're going.
Yeah, no, Michael, I appreciate that, and I think you opened up with describing MRP as an innovative company, and I'm lucky that they brought me on, about 3 years ago, and that's absolutely a hallmark and reputation of this group. Zach Wade, who I know you both know, Jamie and Michael, and Allison Johnson, who leads up our property management group, and who is the creator, the architect of our Heyday concept, and has executed and brought it to market. But MRP is absolutely a visionary and innovative group, and I think that our boutique and work at a small scale allows us to not trip up in taking that vision to an executable phase. And so it's just been a really rewarding group to work with and fun to be part of.
That's awesome. Well, hey, we're glad you shared your experience with us.
My pleasure. Thanks.
Thanks to you both.